Today I'm going to be talking about the quantitative easing that central banks introduced 10 years ago and what the results of that have been. And then we'll look at what the potential consequences of unwinding QE will be, especially for gold. So, briefly, 10 years ago after the credit crisis, oh sorry, I'm not supposed to touch this, the Federal Reserve in the United States and many central banks around the world introduced unprecedented moves intended to boost the economy and to boost inflation. Part of this was to increase balance sheet. The Federal Reserve's balance sheet quintupled from 2009 to 2014. And part of it was to lower interest rates to all-time historic lows. And when I say all-time, I mean all-time historic lows. This graph goes back to 3000 BC. And we have never seen interest rates as low as they are today, or last year, let's say, in all of history. So in the United States, interest rates went to essentially zero, but in many other parts of the world, as you know, they went into negative territory, which basically means that if you lend money to me, I guarantee that I will give you less back, which is a very peculiar concept when you think about it. Now, I would argue, and it will take more than 20 minutes to argue, and this is only part of what I'm talking about, but I will argue that quantitative easing was not only a failure, but it was actually counterproductive in terms of what the Federal Reserve and central banks were trying to achieve. So the result of this unprecedented monetary growth and unprecedented low interest rates intended to boost the economy in the United States was the lowest recovery in 3/4 of a century. The lowest recovery in 3/4 of a century. And coincidentally or not, the economy in the United States, recovery in the United States only started to take off at the end of 2016 when the Federal Reserve announced the end of quantitative easing, and perhaps coincidentally when Donald Trump was elected president. Whatever the reasons, while QE was underway, we had the lowest recovery for 3/4 of a century. QE was intended to boost GDP. So let's look not just at the United States, but let's compare countries that had excessive QE with countries that didn't. And as you probably know, living in Canada, in Canada, the balance sheet of the Bank of Canada was about 5% in 2008, and it was about 5% in 2016. Didn't change at all. In the United States, the Federal Reserve's balance sheet went from 4% of GDP to 24% of GDP. The two economies are, you could argue, at roughly similar stages and subject to roughly similar shocks. So the consequences, this should be a real live test of whether QE did any good. And the result was that the Canadian economy actually recovered stronger than did the United States economy. We can then look at all countries around the world, and it's not an absolute correlation, but it's pretty darn close. The countries with the highest QE, like Belgium, Spain, Italy, had the lowest economic recoveries, while the countries with the lowest QE had the strongest economic recoveries. Now, what's this chap doing here? I'm going to look at inflation. And the Fed was worrying that inflation was too low, which is a peculiar thing for a central bank to be worried about, in my opinion. They're supposed to protect the purchasing power of a currency, and they're worried that inflation is too low. Nonetheless, The Federal Reserve in 2018 was still worrying that inflation was too low. So certainly in the United States, they did not achieve their objective. What about in Japan, which instituted QE on steroids? If you read this comment here from the governor of the Bank of Japan, each time central banks have been confronted with a wide range of problems, they have overcome the problems by conceiving new solutions, which is another way of saying we don't really know what we're doing, but we're going to keep experimenting every time we have a problem. So was the Bank of Japan successful? Well, here is the growth rate. Doesn't look to me as though QE achieved much in terms of growth. What about inflation? Well, the money supply went up and inflation went down. So that didn't seem to do much good. And in both Japan and in the United States and in other countries, you had an incredibly low, a decline in the velocity of money, meaning money, the rate at which money circulates, a decline in the velocity of money, and hoarding took over. The Federal Reserve Bank of St. Louis, now this is a Federal Reserve Bank, this isn't some crazy, independent right-wing economist or something. The Federal Reserve Bank of St. Louis did a study on the effects of QE. And the conclusion of this long paper was there appears to be no evidence that QE works either to increase inflation or to increase GDP. This is the Federal Reserve itself. So one has to ask, what on earth was it all for? What was the point of it? Not only did QE not achieve its purposes, and as I say, if anything, it was counterproductive when you look around the world, but of course there were many negative consequences from QE. And I'm not going to run through all of these, but you can see some of these consequences. And QE encouraged debt. So even though debt was one of the causes of the crisis in 2008, because of QE, debt rose to even new levels. It encouraged zombie companies to survive. And as I mentioned earlier, money didn't move. The money supply the money in the U.S., velocity of money in the U.S. collapsed to long-term lows we haven't seen in basically 80 years in the United States because of QE. And velocity of money is important because that's what helps an economy going, and that's what boosts inflation. And the reason in the United States that velocity fell was because banks, the money center banks, were actually paid not to lend money. They were paid not to lend money. That sounds like a very peculiar policy if you are making money available to the banks, hoping to boost GDP. So what happened was in 2008, the Federal Reserve, for the first time ever, decided to pay central money center banks on their excess deposits. This to me was one of the most idiotic policies that they could have come up with if the intention was to boost GDP. Because what happened was the Federal Reserve made money available to banks at zero interest for about 8 years. They made money available at zero interest. The banks then could turn around and put that same money back on deposit with the same institution that had just lent them the money and earn 0.25%. Now, I don't know about you, but if I could borrow as much money as I wanted at 0%, give it back to the person who lent it to me and earn 0.25%, I think I would do that rather than lend money to small businesses. And so for 8 years, basically, small businesses couldn't get loans, very difficult to get loans, with the result that the real economy in the US struggled to recover from the credit crisis. And excess reserves, needless to say, not surprisingly, zoomed after 2008. Of course they did, because it was easy money and free money and no risk money for the banks. Now, what's happened in the last couple of years, as the Federal Reserve has started to raise interest rates, and you may recall that the very first rate hike was in December 2015, followed by another very small hike in December 16. So it was only in 17 and 18 that they started to raise rates in any meaningful way. But as rates moved up, the risk-free trade ceased to be so attractive because the banks now had to pay money to borrow from the Fed. So it was no longer so attractive. And so that money in the last year or two has slowly started moving into the real economy. One of the results, as I mentioned, was that the GDP has moved up in the last year and a half, last 2 years. The other consequence that I think we are going to see is inflation, right? Because when the Fed creates, in order to have inflation, you need several things. You need to create money. Well, the Fed did that in spades, no problem. The banks, however, who borrow the money, need to lend that money into the real economy. That's what was not happening. That's what is just starting to happen. But all that money that the Fed created in 10 years still exists. It still exists. And so if the banks start lending that money into the real economy, I think we run the risk of inflation accelerating in the US after the traditional lag of a year or two. So I've talked briefly about some of the consequences of QE. The Fed ended QE at the beginning of 2016 and has a plan to reduce the balance sheet and to raise interest rates. The European Central Bank announced in December they would not be buying any more assets after the end of the year, and from the middle of the year they would start raising rates and reducing the balance sheet. And the Bank of Japan has also stopped buying new assets for the bank. So not just in the United States, which was first to end QE, but also in other countries around the world, they are turning slowly from QE to quantitative tightening, or QT, as they like to say. It sounds very cute, doesn't it? But it isn't. So just as QE had consequences, then we can expect QT, surely, to also have consequences. Some of them are known, and some of them we only have to sort of surmise at or guess at. Now, one of the consequences of QE didn't do much for the real economy, but it did boost the stock market. The stock markets around the world would, of course, recovered from their lows at the beginning of 2009, with or without the Federal Reserve, but QE helped to prolong those rallies. So when the Federal Reserve and other banks withdraw liquidity, and October last year was the first year since the credit crisis that, on balance, central banks withdrew, in aggregate, central banks withdrew liquidity rather than put liquidity into the system, right? And coincidentally or not, when the central bank started, on balance, withdrawing liquidity, stock markets started going down and getting volatile. If the Federal Reserve and other central banks continue with QT, then you are going to see stock markets hurt significantly. Now, with that, of course, you get declining asset prices. You also get volatility in asset prices, both of which are good for gold. So as the stock market started to decline and the stock markets got more volatile, we all know that gold did well against that. So that's a positive for gold, if not a positive for stock markets. I've already mentioned inflation, and that I think we will see in a couple of years, and that will be a positive for gold. Yes. Again, very, very peculiar for a central banker to be saying we would like to see an increase in the inflation rate. Now, I want to emphasize that even though the US has moved rates to a positive, other banks that introduce QE, mostly in Europe and Japan, still have negative rates. So as they turn towards tightening, we still have a long, long way to go in this process. Already, the Federal Reserve is beginning to have doubts about pursuing this tightening policy because they have seen what happens to the markets. So already they are talking about putting interest rates on pause and not, we don't have any specific plan to follow in reducing our balance sheet and so on and so forth. So I think the Fed has already cried wolf, if you like, and is on pause. And again, that is very, very positive for gold, because if a central bank doesn't pursue the policy that it thinks it should because it's scared of a market reaction, right, that is very, very positive for gold, which, if you like, is a kind of anti-central bank asset. When the central bankers were on the front of Time magazine, written up as man of the century, right, and everybody was bowing at the feet of the central banks, gold was doing very badly, because most people thought the central banks were in control. It's become very clear since 2008 that the central bankers are not in control. It's become very clear that the central bankers really don't know what they were doing and were experimenting, and so that becomes very positive for the anti-bank asset, which is gold. Now, central bank interest rates, of course, have moved up, and they will likely continue to move up on balance, but not anywhere near as aggressively as the Federal Reserve was hoping. So I just want to finish by looking at what higher interest rates do for gold. Because the common assumption is that rising interest rates are negative for gold. And I want to show that that's not necessarily true at all. It all depends on the circumstances. This is 2015, 16, 17. You can see that that's when the federal funds rate in the United States started to move up, right? The first rate hike at the end of December in December 2015. And during that period of time, gold also moved up. You can look back to 2004 to 2006, when there was a whole series of interest rate hikes. We tend to forget about that, right? But there was a whole series of interest rate hikes, and during the same period, gold also moved up. And then, of course, most famously back in the 1970s, you saw, in the second half of the 1970s, you saw interest rates move up very significantly from 76 to 1980, to 1980, yes. And at the same time, of course, gold moved up from $200 an ounce to $850 an ounce. It was only when Volcker came in and ratcheted rates up to 14, 15, and eventually 20%, right, ahead of inflation, it was only when that happened that gold fell. But when interest rates are moving up, and when interest rates are moving up at a slower pace than inflation, then gold will do very well. And I don't think that we are anywhere near where in the United States or in Japan or in Europe we are anywhere near another Volcker coming in and ratcheting rates up. So the environment, from an interest point of view, from a monetary point of view, the environment for gold looks very, very positive indeed. Thank you very much.